Check, check. Oh, you can hear me now? Yeah. That's like a microphone. All right. Yeah, looks like a microphone input. How does it sound? Does it sound weird? Does it sound all right? I can't hear myself. Let me go to YouTube real quick. Would this be a good entry? Let me double check. SPY. Can I see my screen? Hold on, let me put this over here. The hell? My screen just went blank. There we go. It looks good. Half gap of support. Yeah, I like 408 and some change. Just making sure this holds yesterday. So Powell's commentary could indicate that they are ending. As long as resilience is above 0, half gap we expect to stay support to fill the gap. The redistribution zone. This is a gap and go, so we're outside of the redistribution zone if we are above the open price. So here is the that's fast. Mouse. So this is the close of the previous day. This is the open of today. In between the open and the close, let's find the exact candle of the close. Open and close. This is the redistribution zone, this tiny little spiral here. If resilience is positive, then it wants to close the gap this way. If the resilience is negative, it wants to close the gap this way. So it's a tiny little range right here. Keep an eyeball out on this number right here, this resilience number. Okay. As long as it's greater than 0, this is support. And as long as you support the redistribution zone boundary, which is the opening price. I don't know what just happened now. Oh, 10 o'clock. So let's look at the news really quick. I'm so far behind because everything's been in pieces on the floor. What am I looking for? So yesterday commentary from Powell has indicated that they may slow down on QT, which is again as part of the thesis, right? They're going to do something. Maybe not change the rates. We thought it was going to be changing the rates, not tapering. Tapering of the rate hikes, so going to 50 bips instead of 75. His commentary was almost, we're willing to slow down QT or something like that. Like let's go read everything exactly. So I saw it on my newsfeed. I didn't exactly read all of it. My computer is still in pieces. I'm almost done building it, but I'm missing some things, and that's kind of the part that sucks. Today's the initial jobless claims came out this morning. We'll go through that, and then we'll look at resilience is positive, so it's a gap and go probably. I think we're still good. Okay, Powell had said. So let's pull up the jobless claims as well. So this is part of the thesis, right? Initial jobless claims. Let's go to 8:30 in the morning, my time. As long as this number is continuing to rise, that's a sign. It's not a bad sign to see unemployment go up or unemployment filings go up in the middle of this environment, because as this number goes higher and higher and higher, even though it's lower from last week, it's still generically trending higher over the course of the average, right? So the average is about, like right here, it's still pushing higher. That's a sign that Powell's going to act in that way, that predictable way, to say they're going to do something to ease up on the pressure. And that was part of the thesis, and we seem to be right. Oh, we had PMI as well, I think. Yep. Let me double check that. And the last part of the numbers here. Somebody said that in chat as well. I could filter out all the United States one. I mean, the non-United States ones. Sorry about the clunkiness today. Where's the apply? Okay, let's go. That's much better. Here it is. and it was less than half. It's been in decline, and now it's basing out. So this is a time when you're starting to see companies lay people off. Like, these layoffs are very common. To cut the fat from the company, first step before you go into full blown, laying off your efficient labor, because the company is just losing performance. So as you see, a lot of the companies, the bigger ones out there, are cutting off some of their workforce. But it's not to be. The unemployment filings are going up, but as you know, it's the inefficient part of the workforce first, and it's saturating the labor market. And this is part of the thesis, right? You lay off those people who are, not producing, or not needed for the optimization phase of a recession, where companies are trying to optimize and do better in the environment. So resilience just went negative. That's to fill the gap this way. It's still a BLU on SPY, so I'm looking at 406 to continue to move. Let's talk about the numbers this morning before I go straight to the thesis. This to me is an entry signal. All through here, losing 406 is a stop loss. If Powell is doing anything to stop or aid in the ending of the recession, that's a good thing. Again, they're not going to stop. This is the theory, that they're going to slow down this year, early next year, to keep the market from plunging to zero. And then they're gonna pace on those rate hikes, and the rate hikes are gonna get higher and higher and higher next year. They're not gonna stop that, but the market's gonna rally while they're raising rates. This is very much like the 80s. I put a whole thesis on that, and it's looking pretty nice. So the number on the PMI being less than half is just showing a slowdown in the industry. That's normal. People are now finally starting to feel the burn of losing their jobs and buying less stuff. Fewer people, less money, less spending, less production. That's it. So the surplus we had, the lower prices of things initially, is now going to equalize. The people that are getting unemployed, first-time unemployment filings, we see, are still going up above the average. Even though I think it was a beat today, you still have to look at it in the overall sense of, let me get back to the jobless claims number. It was a beat against the forecast, but when that number goes up, it's good, because the biggest cause of inflation right now, if you guys can tap that like button, please, I would appreciate that. Everyone scroll down really quick. I'll run my scanner settings real quick. We'll look for some place. Hit that like button, por favor. Y'all know the rules. Let me get you guys your roles if y'all need to get into the Discord. Let me get everybody in. There's a lot of people trying to get to the Discord real quick. Okay, so I'm liking this monthly hedge pressure hold on QQQs to BLD, which is good. I'm looking for that monthly hedge pressure tap. I need to move out some of my Qs all the way to the 23rd. I'm on my laptop. One bite, everybody knows the rules. I love it. That's right. I could use a slice of pizza, to be honest. Okay. Okay, let's go. Let me look at Powell's commentary from yesterday. What unemployment's still low, the Fed's in a position to get inflation under control. Okay, so this is the point. Inflation has been caused by the inflation of wages from the lack of labor that we had going out of COVID recovery mode. right? People lost their jobs, then labor got very competitive, and people were wanting a lot more for the job and the risk they were taking. Now you see when you can't shut down the economy of the globe because of COVID, or else you'll have this. I mean, you should if you believe that that is the safe play. But then those who go out and do work in those environments do take the risk. They get the reward. They get paid more. So that labor shortage is what built its way into the economy. And then, of course, we had wage inflation, which caused cost push inflation, which overall, in general, had a, because look at 92.5 bounce at Q. So let's keep an eye on that. Is what happens. So when you have a lack of labor and an abundance of jobs, then people have the control to claim whatever they want on their negotiations, and that companies are desperate to hire, they'll take whatever they can at whatever price. In that mode, we had inflation built off of lack of raw materials and the overpricing of labor. Now, as people are being laid off against the available jobs and jolts are coming down, which is the other metric we look at, when jolts come down and unemployment filings go up, it means you are now saturating the labor pool with unemployed workers who are not necessarily bad at their job, they're just not the best ones out there. So the jobs are full. When jolts come down, companies are cutting jobs or eliminating jobs and then saturating the workforce, which means now you don't have the availability to get whatever you want in your salary. You now have a lot of competition to get the only job available. So now wages are going to plunge, which is exactly why inflation is coming down. It's not anything to do with the Powell's actions, nothing to do with the Fed. They're not doing anything to control that kind of inflation. People getting laid off is naturally bringing wages down because people are like, shit, I need a job. I can't ask for like 20 times over my salary. I'll take whatever I can get. So that takes a little bit of time, and that will pull inflation down, which is what we're seeing. So when you start to see that unemployment filings go up, smart traders are going to start betting that inflation comes down. And if Powell and the team over tighten or completely plunge the economy to recession via stock market crash, which causes everybody to get laid off, which will halt productivity to zero again, just like COVID did, induced by the Fed, then that's a bigger problem that they don't want. So they're not going to do that. So the thesis is that they will tighten to a degree that people are getting laid off too much. They want to tighten to a degree that people are getting laid off just a little. As the Fed is smart and Powell is smart, they understand that. You guys understand that. Does everyone understand that reasoning? They wanted to induce a little bit of layoff, not a lot, just a little. That was the whole strategy from the start, and we predicted that from the start. All the FOMC wants to do is put a scare in everybody so that we lay people off so that wages come down. Wages come down, inflation comes down. Raising rates and all that is just a way for them to make a little bit of money. QT is just a little bit away from them to put a little cash on their pocket and get risk off their backs at the high of the stock market. Because the stock market also inflated post-COVID, and that inflated unnaturally. And they kind of need to use that liquid period of the market to start escaping the effects of the QE from the last recession. It's a brilliant timing. It's a brilliant play. And now that inflation is starting to come down and unemployment is starting to go up, they need to have that commentary that says they're going to slow down. Because if they don't, then the 10% becomes 30%, 50%. Companies might lay off very rapidly, which would have the inverse effect. You have two competing things going on. Number one is when you lose workers, productivity comes down. We know if you look at inflation, right? If you look at the economy, GDP grows based on productivity growth. Like you make more material, you sell more material, you make more money, you make more material. And then the more commerce you have, the more jobs that are created, the more people with money to spend, the more stable the economy. So the more times money exchanges hands, the more stable your economy is. You also have credit cycling, which is people getting loans off the effectiveness of them keeping their job for a period of whatever time it is to pay that loan back. So banks will loan out more money, which increases the rate of spending disproportional to the productivity. So we're making a certain amount of stuff, then people are now going out getting credit cards and borrowing money against their future self to buy more stuff, which is essentially what you're doing when you buy on credit. So the bank is like, well, this is the probability they're going to keep their jobs in X number of years. And so that enhances that. So when you lay people off, credit slows down very, very rapidly. So you can't over purchase against productivity. So, but when you lay people off, wages come down, therefore prices come down, and people with the same amount of outstanding credit or money can buy more stuff when the price comes down. So you can increase commerce by inducing layoffs that causes wages to come down, which means prices ultimately come down. But that's a slower moving ship. And so they can't crash the market too quickly. So you get a lot more people laid off, which means the credit dries up. So you can't have banks stop lending to people because too many people got fired. But you can have just a little bit of layoffs to trim the fat. And that's all they wanted to do. Let's see what's going on here today. All right, let's look at QQQ, BLD. I need to use this opportunity to reposition my Q, all of my Qs. Hold on. My Googles, let me look at those really quick. Let me check what Q is. I need. Okay, I'm rolling my Qs into all December 23rd. Let me double check these. Let me run a monthly map really quick. Okay. Let's see if I can get myself. Let's check the rationality of the markets. Let me double check this really quick. So this morning, oh, I didn't even realize this. Let me pull these up really quick. I have a random rogue. That's the old PPI. Let's delete that. Let's double check the irrational stuff. Catalyst. NQs at the bottom. VIX is hitting that old September triple B. So be very careful here. We are pumping in the irrational side. So what I did was I closed out my December 9th Qs. All of them. Can you guys tap that like button? Don't forget, everybody in here. Give it all a hit. Like I said, we get up to 50. I'll go ahead and talk about my scan sevens. So, okay, let me go ahead and my sounds are really loud. Hold on a second. Check, 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 check. Check, 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 check. Okay, good. Okay. Okay, I'm rolling my Qs into December 23rd. Just on the step. I should have sold at the high, but I wasn't paying attention. The high of the day, and then bought on the step. Okay. Let me check out my position. So I'm rolling all my Qs in the 23rd of December just to give me some more time. on them. There's still 310s. Get back to here. Perfect. Okay. DD falling today. So here's one of the things we're going to talk about, that the DD number was greater than half the entire time. DD is not falling today. The DD is certainly more bullish than it ever has been. This is an entry signal from Q's 291.5. You see right now is where exactly where I rolled into my December 23rd. So I bought my 310s just now. It's for a swing, even though we're losing a monthly hedge. I'm going to use today. If we collapse today, then that sucks. But if not, I'm going to undo my position for tomorrow. How do you swing using Rocket Scooter? Yeah, you want to learn how to do that? Value of my portfolio, 420 million. 420 million. That's a weed joke. How big is your portfolio? I think there's $5 in it in my portfolio, maybe 10 if I look. Five whole dollars, maybe $4. Market's pulling back. Okay. Things are looking all right. So let's go through and we'll double check everything. So let's go through our rationality things. First thing you do every morning is you go through here and you double check this. Now, sorry about like everything being all in parts of my floor. So I'm building a massive trading computer. It's the best trading computer any trader you'll ever watch streaming. I promise you that. Everything is next gen, state of the art. There is nothing that is one generation old. So I spent over $10,000 on stuff for this computer. It is designed to be a streaming computer to facilitate not only having 8 monitors, but there's enough CPU power and extra computers in this box. There's 2 computers in a box and capture cards. There's all kind of stuff, and it's designed to run a live broadcast news show where I will have other video feeds tying into my computer where other people will appear on my stream. If you look on my screen, there will be people and people and people and people, and there will be live broadcast editing, multiple cameras, multiple camera angles. I'm building this machine to start essentially like an ESPN style news show for sports, but for stocks. And it's going to have a lot of people in it that you guys know, a lot of famous traders, a lot of really cool peeps from the Twitter world, a lot of whatever. We're going to have like scheduled events, scheduled folks. It's going to be a massive. We've been building this entire thing for about a year. Not the computer, but the design of the show. And that's why my computer's in pieces. And the problem is there's pieces of my computer that have that need to still come in. I had to order some more stuff because I added a few more things. So as I was buying my last few parts, I've been collecting parts for over a year as well. I ran out of a few things. So I'm loading up at this dip right here. I'm rolling my QQQs out. So I am at the bottom of DD band. DD is greater than 1/2. We open in the band. I'm expecting to go to the top of the band. So even so, as long as the market stays rational, this isn't a terrible sign. And this is an entry point on the doomsday trade by itself. So right now, what I'm actually going to do, and let's do a red line on this. Let's do them both while we're here. If you guys want a little quickie on red lines. But all my stuff is on the floor. And my actual computer, my laptop that I'm using on, normally is configured for travel. But since I've been using the laptop, I'm actually filming a video of my PC build. And it's kind of funny because I'm not just like filming a PC build and making it boring. I'm trying to make it goofy and fun. Just like, I guess it'd be boring. Nobody wants to watch you build a computer. There's a lot of them out there. But, I am imparting some of my PC expertise and things I've learned. These dual builds are not easy to do. So there's a lot of little nuances to them. So there's not a lot of videos on this particular setup or case and 12th gen. I use Intel, only Intel. Not that I'm against AMD, but I'm just an Intel fanboy. I've always used it. Well, I mean, let me tell you, right? Like I used AMD maybe when I was in high school and college for a little bit, but I've always used Intel to overclock. So I'm an enthusiast. I love tinkering with the BIOS and playing with all the voltages, and I'm just so used to the Intel chips. It's like I have that kind of like feel for how they work and feel for what I need to do with them. And AMD would just be like starting over. And I'm an old man, no time to start over. Even though the new AMDs that are coming out are certainly superior, and they have been for a while out the box. I still overclock like this. My current PC is overclocked to 5 gigahertz, and it runs super cool. The new one will be like that. Get 2 CPUs in that. 12th gen, or Gavin would love me. Or Gavin already loves me. Okay, let's do this. This is a run length red line here. And the impact. So let's get those guys done. Let's do the second one. Y'all know how this works. He might even be on the show sometime. That's already been clobbered. Actually, no, sorry. Hit that space bar to make a copy on Thinkorswim. Get yourself a second little drawing. Boom, 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 boom. Okay. Keep an eye out today for this move. UVXY is irrational. Oh yeah, so we'll check that. Let's do I have my boxes on the S&P? People are going to try to fade this for sure. There's an old red line. I don't know what that's from. Oh, I know what that is. That is that old ES red line. That 4056. That's right. I haven't updated my risk intervals in about a week. I don't think they've changed, right? Why did I do those red lines in the wrong chart? Let's just write that down. 30, okay. 39, 64, 40, 21. I'm just right. I put these on the wrong chart here. 11804 and 11569. Yeah, let's watch that irrational VIX today. So let's be very, 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 very careful. There's a yellow line at 41.46. That is my target for this run. That one's gone. That one's gone. Okay, I'm just gonna draw these. We just keep history of them. Pretty soon they'll be in the Rockstar platform, which is great. 39.64. All right, everybody, scroll down, tap that like button. I'm giving y'all 10 seconds and I'm getting out of here if y'all don't do it. Let's see at least 75 likes today. Let's go. I had to reconfigure my laptop. It was set up to film. That's why I had to reconfigure everything, because I had all my cameras plugged into it to film all the different angles and stuff. I'm making it super kinky. You know, catching that computer from all sides. Ooh. With some fancy lighting. It's hot. You've got some teaser photos later, but it's missing some crucial tiny little components for the water cooling stuff. So I'm stuck because I took everything apart. My graphics cards and my solid state drives have all been pulled out of my old machine. So I can't even load it back up if I wanted to, unless I took apart all the cooling components. And I'm always at the store. They have a computer store here that has components, but they didn't have what I needed. But while I was there, I did get the brand new 990 Pro Samsung solid state drives, the brand new ones that just came out in October. And that was hella cool. And it's funny that every time I go, especially for this setup, every time, you know, the funny thing is that I feel like you guys remember the old memes about like Duke Nukem 3D? I remember that game. That there's just such a slow development process every time they go to develop. They'd have to. It was like this old meme from back in the day that the new Unreal Engine or whatever would come out, and they kept changing how they were going to do it. So they just never finished, and it's like 10 years to make the game. Do you remember that? So it's like this. Every time I go to buy something or do something, I'm like, oh shit, they have new components that came out, new things. So originally this is going to be a 10th gen build. And so I started collecting stuff around COVID. And I was just going to do, because the 11th gen came out, and the 11th gen Intel is just a waste of time. Like everybody agreed that the performance increase over 10th gen was very small. And nobody wanted to go out and buy like the 11900s because they just, in the enthusiast communities, they just weren't worth the bump. But the 12th gen was, like, which just came out. So 11569. So I skipped a gen, which normally I don't do. This time I did. But it, you know, plus when you overclock, you're not going to see much of a difference in those two generations. But the 12th gen you will. So I was going to build the 10th gen, and then, you know, COVID happened and everything was staying back. I got 3080 Ti graphics card. I got two of them, right? You don't need two of them because the second one only runs monitors, which is overkill for it's like buying your Gucci shoes in two different colors. You're just buying an extra one because you can. I wanted symmetry in the case. I wanted to look nice when I water cooled it, so I wanted the same graphics card twice. It's powering 8 screens. With flexibility to expand to like big monitors and all that, you know, and it's going to be able to hold high resolutions on the bigger monitors if I do build bigger monitors for my TV production studio that I'm building. So now in my house, I have 2 production studios. I used to have just one. Now I have 2 of them. So 2 setups with lights, cameras, sound padding, everything. So one of them is for the stage film and the other one's for the stream. And so my laptop has been configured just for filming. And so what was going on with my laptop was I had all my camera mic, I have a wireless mic set up. So like, you know, clip on lavaliers. And that was all set up for that. So when my mic wasn't working this morning, it's because my laptop was still looking for those lavaliers. It was working if I would have walked upstairs or clipped one of those on, but I had to go reconfigure everything back to its normal. I don't know what this is, but I'm going to delete that. It's just sitting there. Old red line from way back in the day. Okay. Now I got my red lines done. Double check everything is still stable. Set up good. Again, these are old. I need to be better at tracking my yellow lines. Let me double check this distance. What's the yellow line distance? Can somebody tell me the number real quick for yellow line from the Discord bot? Actually, wait, hold on, let me just open it up. I got it. 860 1/4. Double check it's right. Perfect. This is prep work that you should do every day and every night just before you do anything in the mornings, just to get everything stable so you have my upper targets. And somebody asked how I swing trade. I'm about to go over that. So let's make sure you guys help me out here. Click that like button. And we are going to get ready to go over those techniques in just a second. This is a long entry point on my belief. Let me double check VIX one more time. As long as we stay rational, things are good. So let's double check that VIX irrational side. Don't want to see that market sell off. If it sells off today, it's going to sell off permanently. I don't like the sound of that, so let's be careful. Teach you guys how I know that. This is a nice long entry. This is where I rolled my cues out. I posted in chat, I think my positions were up like 30K yesterday, something like that. So I'm excited to see. Okay. Okay, guys, ready? We're going to give me 2 more seconds. Give me 1 second, you guys. One more thing I got to look for. And we'll get started in just a second. That was in place today. Okay. Okay. Let's get ready to do this. All right, I'm gonna go over. We're gonna do monthly map. I'm gonna show you guys how I do what I'm doing for Qs. Okay. Let's go. All right, you guys ready to do this? Yes, this is an entry point. This is why I'm redoing, for me, I'm bumping my Qs out now. On this dip, I'm rolling my Qs out another month. Remember, whatever I posted yesterday in chat is how much my positions were up yesterday. And that was just my, I don't remember where I posted it. Maybe in the trading chat. Here we go. I was up like 30K yesterday on my swings. All right. Let's see if I can get this over here. Right here. This was just my Googles alone for 22,000 bucks. This is from the Rocket Scooter account, the official account. My Qs are also over about 8 grand. So total, I was up about 30K yesterday in my live trading account. So this is all my swings. This is what I'm calling, quote unquote, my $1 million trade. I keep rolling it. I keep pushing the date out. So those are my December 22 weeklies. Did I say December 23rd? I keep meaning December 22nd. No, I mean, sorry, December 20. Okay, I'm stupid. December 23rd is where I'm rolling everything out to. Those are my December 9th Googles that are in play for Friday, that are in the money at 100. Let me quote myself correctly. So I have Googles that are in the money at 100 for December 9th. That's one of my older plays. I'm deciding if I want to roll those out or not. So let's get Rocket Scooter front center. Everybody make sure you grab the free trial of the platform. Let's get Rocket Scooter front center. Let's look at Google. Let's see what Google's doing today. Do I want to hold these Googles? Let them decay a little bit. They are in the money. Let's see what it is. And they stay above 100 and we're good. If we lose 100, I'm just going to close them and we'll be fine. I'll finally take the profit on those Googles. I bought them way back in the day when Google was like, I don't know. Let's double check on the daily chart. So everybody get to Rocket Scooter platform. We'll do a monthly map together. I bought Google before earnings. I bought 110s, just a little bit of them. And when Google dipped, I bought 100s. And when Google dipped, I bought 100s. And when Google dipped, I bought 100s. And Google, you guys saw my plays on Google, made close to like 100K on Google. Y'all remember all those posts over the last couple of months? Just that trade alone was about 100K. Y'all remember all those trades. And I rolled out of some of the 110s. I rolled out some of the 100s. Just now, I'm sitting on the 100s. The last bit of my trades. Hold on, let me double check. Don't let me confuse myself. So all I have left on the Google are the December 9th, 100 calls. Sometimes I get the numbers backwards because they put the 9 December 22, and I keep thinking December 23rd is the strike date, and this on Thinkorswim labels it backwards as December 22nd. So I was confusing myself earlier. December 22nd is December of 2022, and they expire on the 9th. So these are the last ones I have left to roll to December 23rd if I want to roll them further. The question is, do I want to take profit on them or not? They are on the money at 100. Finally, after all this time. So now I'm at 50 Delta, and now things are looking pretty solid. Let me check the let me check my Greeks on those. One moment. I'm just going to observe what the theta decay is. I'm doing this on my phone. Take the IV really quick and the theta. It's the only thing I really care about now that's in the money. And we're going to see if I want to roll these out or not. Okay, it's theta is, guys, I know theta is the highest at the money. So just FYI, if we hug 100 for the whole day and don't break out, I'm going to close them out. You guys know that, understand that, right? Your theta is the highest at the money. So we need to break to 101 and keep going. Or I'm losing 12 cents a contract at current 150. That's a lot, right? So 1/12, those 8% I will lose just on theta alone. Right? So the way theta works is when you're at the money, theta is the highest. So you need to brush out of that at the money spot so that you lose less theta. Do you understand how that works, everyone? So theta is a really sharp curve right at the money. So if it strikes at 100, if we're sitting at 100, I will lose the most theta the nearer the money you are. So theta is really high near the money. And it gets less the further away you are. So I typically buy options 3 weeks out. On my swings, yeah, you only have visibility up to the monthly. That's why I only do about 3 weeks out. This is part of the monthly map strategy. Everybody click that like button on the stream and I will do a monthly map for you live. So Google's at 110 are perfectly fine. So the way theta works, let me see if I have a drawing tool here. Got Epic Pen on this thing. I don't have a drawing tool. I need to do it. Okay. All right, everybody, scroll down, smash that like button. I'll do a monthly map. I said if we get to 75 likes, I'm going to sit here and drink my Celsius. We'll do that in just a second. Everybody, hey, Dimitri, what's up? You're right today. We should consider shorts in Q and ES on each rebalance up, or we should consider shorts only after the price breaks down hedge pressure level. Okay, so in a rocket scooter sense, it's not investment advice. Rocket scooter shorts, I only short the index when we open below monthly hedge pressure, and I short against it. That is confirmed bear structure. It's this yellow number you see on the screen, and we are completely opening above it and recovering off of the potential break. This is a long entry point, not a short entry point. I don't chase the short on monthly hedge pressure breaks, and what you see on the screen is exactly why I don't do that. So it is, to me, in my opinion, a not short entry, but not long either if resilience is less than 0 on SPY. So we need to see this white number above 0 for us to break out of this. This is likely the only upside we'll see for the moment until resilience comes up on SPY. Let me show you what I mean. So right now it's going to bounce around here for a little bit. It's not going to break and rally just yet. You can predict that very easily with Rocket Scooter. So you might say, ooh, this is a dip to buy. To me, it is a buy signal, but it's not going to V up and rally until this white number goes above 0. And it's very, very, very low right now. Does everyone see resilience? So what I expect is a second test, like another big red candle to try to break through hedge pressure. Do we all understand why that is? Alan Gross said repaired after refresh. Yeah, take notes of some of those things. We're going to do optimization project first of the year. So swing trading, you guys ready to see that? See my swing trading tricks? Let's get some chatter in chat. Who wants to see how I look at my swing trading? Number one is, do you guys understand how theta works? I'm asked that for the 4th time. Do we understand theta or not? If you're trying to swing trade and you don't understand your Greeks, you are wasting your time. Okay. Actually, I don't want to. I'm going to make me a coffee. So right now we're going to bounce around hedge pressure, and it's likely going to try to attempt to sell off. So be careful. There's resilience. All right, let's go. Yeah. Okay, good. We'll go through and teach you guys how the theta stuff works. So there's a couple of Greeks that matter, but we exploit all of this in Rocket Scooter. So you just have to have our platform. You don't ever have to think about it. It just does it for you. So we'll show you the different pieces just in general of why, in theory, why I swing trade to a certain distance and things like that. Okay. Hey, JJ, did you happen to get the Discord thing figured out? Send me a message with your Discord account. I know there was some issues with the phone number thing. Join Discord in general. You don't have to have a phone. You have to have a phone number, but I can manually give you the access. So send me a message in our Discord. Add me as your friend. And then send me a message and I'll manually give it to you. Hand of God, data in 8-step extrinsic value, especially under 45 days and out of the money options. Dude, you're nailing it. Okay, perfect. Get it. Okay, so let's talk about, yo, what's up, Ashton? How you doing, brother? Things are good. So I just rolled out of my QQQ that were December 9th 310s. I don't think they're going to go in the money, but they did make a pretty penny yesterday. I rolled them out and I pushed them to December 23rd. So I have 310 QQQs. My Googles have made over 100K. So I'm excited about that. My Googles that are now at 100 for December 9th, that's this next Friday after this one, are at the money. We're going to talk about Google really quick. And this is going to do a monthly map on Google and plan it out a month in advance. How's your trades going today, brother? So your theta burn, right? You want to pass through that hump of being at the money, right? And so in this window, right, my Googles expire on Friday, and they are at 100, right? You're gonna have theta burn, and if you look at your theta on any options ladder, you will see that the majority of that takes place at the money. So whatever your strike price, say by hundreds, for instance, I will show you all up and down. Like if you look at an example, so let's pick 100 as an example. The difference between 100 and 95 is like 12. It says 0.12, so $12 a day per contract versus $5 a day. That's a $7 difference in the money. But if you do 5, so I'm looking at, so an example is, I wish I could draw on the screen, the difference between out of the money and in the money options on the theta. Okay, so 100's the strike. So if I go to 95, the difference is $12 loss per day. So theta is usually displayed in loss per day. Now theta is a real-time decay, as Ashton is like the guru on theta. He'll tell you everything you need to know about how theta works. Theta is a real-time loss. It's like interest rates. It's calculated in real time, but it's presented to you as a trader so the loss of decay is in real time, and a lot of times it's realized as the price changes, usually at the end of the day, or especially there's holidays, there's a lot of effects to it. But if you just think of it like the number you see on your platform is how much you'll lose per day on average, with all things being equal, without unusual activity like volatility or whatever. So let's pretend everything's the same and nothing's going to change. The theta decay at the money is $12 a contract here. Now, if I were to look at the difference between $5 in the money and $5 out of the money, because they're calls, the $12 lost per day on the contract that's worth $1.50. If I go to 95, it's only $6 a day. So it's only losing $6 a day being out of the money. I mean, in the money, not that much. But if I am effectively, right, so on paper. So if I go $5 the other way, it's actually losing $9. So being out of the money, right, you're losing theta faster. So if I had 105 strike, it's going to burn faster. And so when you go out of the money relative to the price you pay, you're going to burn up that extrinsic value much faster the further out of the money you are. So once you go at the money or in the money, you're pretty much safe on a relative distance being out of the money versus in the money. So if I'm $5 in the money or $5 out of the money, being in the money is less. So ideally what you want to do is you want to get at the money and break through it and hold. So if 100 strike calls, and they're in a very good spot right now. Once you go in the money, delta kicks in, and once you pass the at the money level, gamma kicks in right here. So I got that gamma burst right at the end of the day on those Googles. That's why from here till here, my Googles made another 10 grand just in that little move right there. Once you get that IV adding to the price, once you get that gamma from passing the middle. So gamma is really, really high right at the money. Delta is a wider parabola. So once I pass through 100, my Googles are peaking on their gain per like second, because once you pass through that at the money spot on a big volatile move, or not say volatile, but big like straight run like it did yesterday, then that's probably the maximum gain I'm going to have being around or near the money. So especially like those 110s that I had back in the day, even though Google was trading at like 90, 92, I was still making 20, 30K on IV alone on those big spikes that would move, right? So now let's talk about what I'm looking for. So what should I do? Should I close these Googles for profit at 100? They strike at 100, expire on the 9th. Or should I hold for more, right? Yeah, JJ, no problem. Yeah, I can remember everybody. Even though we have, by the way, we're just about to get our 1,000th paid member. Isn't that crazy? You guys remember we were 10 guys in a Slack room? Now we have 3,700 people in our Discord and almost 1,000 paid members. The Google calls were last week. So some of them were last week, Jay. And the ones that were last week, what was left of them expired out of the money. So I held on to them, and I have Google calls. They were at 2 different times. One of them was last week, and one of them is December the 9th. So I had 110s. The ones I bought before earnings were 110s for last week. And then there wasn't that many of them. And when Google dropped, I bought 100s for this December 9th expiration. So I had 2 different Google trades. Remember that? So before earnings, I bought like 30 contracts or something for 110. And then after earnings, I started piling into 110s and 100s because of this monthly map that I did, which I'll go over in just a second. So now that I'm in the money, right, Delta's pretty high. So I'm going to make more money on the Googles per percent gain. So Delta's a percent gain that you'll make on the option versus percent gain that you'll make, a percent gain of the move, the underlying. So right now, these Google contracts, see if I have I'm looking at my ladder on my phone. Let me add Delta on here. And we'll go over a monthly map. You guys will like this. This is how I do my swing trades with Rocket Scooter. It's very simple. The Delta is 63. So every percent move Google goes up, my options go up 63%. The Delta, like I said, usually once I get 100, 110, let's see, let me go up here. So about every point, it's going to go up, 8. If I go to 102, it's going to be about 70%, 80%. And so I'm getting some good Delta on that. IV's relatively low. Things are good. I'm going to hold on to this position. Okay, let's do a monthly map on Goog. Let me pull up a Thinkorswim chart just so I can draw it manually on there. Because I don't have all my facilities. Google. And get out your classic app if you want to follow along. The only visibility you have with Rocket Scooter is up till the monthly expiration. So at most, I try to go to the monthly or a week after. So you'll see me either swing 5 weeks out or 3 weeks out, somewhere in there if I'm swinging. So I roll them out because what happens is institutional traders typically will hedge the nearer the term monthly expiration for longer positions. Imagine you hold millions of shares of some company and you want to hold it for years because you're planning on it being part of your ETF. Now, the forward outlook is typically 1 to 3 months for any fund or firm. And they will buy the cheaper monthly options for the next month's expiration to hedge whatever they're playing. It's a very simple bet. I bought Google at 90, quote unquote, somebody would say, and then I'm going to buy puts at 85 for this month, and then I'm going to just hold on to and do nothing. That's a money manager choice. They're trying to get into hundreds of stocks, if not thousands of stocks. They're not going to be actively day trading up or down all the time. They're going to be just shifting the position around. Okay. So why would they buy more expensive options for further out as opposed to just protecting their position they want straight up? So typically they're going to hold a position. The dividends are going to come in a quarter, and those dividends are going to buy the options. They usually just buy here. And you can see that from the monthly maps. And the monthly expiration, as soon as you pass through the monthly barrier, the options look a little strange. Like when I did this monthly map way back here for Google, you can see that once you pass through the monthly expiration, you start to see even put walls and call walls flip-flop. Because there's not a lot of hedging beyond the month window. This is a trick, and we'll teach you guys that straight up. Institutional positions right now that are longing, the reason they buy monthly options because they've always did that before weeklies existed. They just haven't changed how they work. And they just work on a month-to-month basis, right? So that helps them with their quarterly planning. That helps them with getting in for dividends, ex-dividend day, things like that. So right now, I'm going to assume that all the hedge funds in the world are hedging their positions by buying this expiration. So anything past here will have limited visibility of what they want to do next month. As you start getting close to here, they're going to purchase the next monthly options, et cetera, et cetera. So let's do a monthly map going up to this expiration, which is the 16th. And the reason, again, I get the 23rd is I want to get 1 week beyond the monthly. And then as we approach the monthly, and get to the very next day, then I consider rolling it out further. Once I get to that visibility again, I will consider rolling it. So now I didn't do anything, even though I should have rolled them way back here. I didn't do anything inside of these couple of days for the most part, because the market was relatively flat and nothing was happening post Thanksgiving, right? You guys remember Thanksgiving, Black Friday, Cyber Monday. So I didn't do anything, even though normally after expiration, it's the next Monday I'll start rolling. But I saw this and I go, let's let that first Monday play out. And then that Tuesday was good. And I go, all right, I'm just going to hold on through the holidays. Came through here, and I was thinking about it. And I said, actually told myself, I'm going to wait till the Thursday to get one more final data point to decide if I want to roll out, get those unemployment filings, the data that's really controlling inflation. As wages come down, more people get unemployed, wages come down, inflation comes down. So I was like, I'm going to wait till Thursday and I'll make the decision now. So I'm making my decision fundamentally to get a good catalyst. If the market rallies very quickly, right? Market rallies really quickly. There's a lot of IV and premium built into those options. I'm not going to, that's a good time to sell and roll, right? If you get a big run, your premium gets artificially inflated due to the implied volatility, right? If it goes up, especially if it sells off. So you don't want to buy something until that volatility kind of dies out a little bit, right? You don't want to go out there and buy expensive options for the longer haul. You want to like let the frenzy die out and the next day make your decision. Do you all understand? So I'm locking in the IV profit at the end of the day if I could. I just didn't have my computer open. And then today I'd be rolling into the new position. That's typically how I do it. If the market's like crashing really hard and premiums are just collapsing, or markets rallying and premiums are enhancing because of IVs, then it's a good time to take your profits on that run. Like my out of the money 110 Googles made a shit ton of money on this day alone, just because of the volatility, the IV. And then it just decayed on Theta as it is. Even though Google was moving higher, they were losing money faster than they were gaining. Gaining a little bit on Delta, losing massively on out of the money Theta burn. So on big runs like this, you want to close out your position and roll it out further. That's a one trick on swinging. So ideally, when those Google 110s made some cash here, you would sell some or all of it and then roll your swing out further. You don't like swing off of this and then typically hold forever all of your stuff. Anytime you get a big run day like this, you want to consider taking some profit and then getting into a longer term position for another rally run. You want to get like 2 or 3 days of rally and close out your trades and then roll them out. If I want to swing for like 6 months, I'm not buying 6-month options. I'm actively swinging. Does anybody not understand what that means or why I'm doing that? Let me know. So like an example, if I had those 110s and it goes here and I look at how much Google is going to move per day on an average day. So I look for these runs like this that aren't big rallies on catalysts. I could say Google is going to move up 94, 87, about $3 a day. And then of course in a bull market, up 3 days, down 2. So up 3, 3, 3, down 3, down 3. So every week I expect Google to move up $3. So far so good. So I just watch what a normal day looks like minus these catalysts. You can relatively see that most stocks trade inside of a pretty normal range. Hedging tends to keep market relatively stable. So again, I can go through any run on the rally. I can say, all right, Google's moving up about 84 to 87, about $3 a day, $3 a day, $3 a day, $3 a day. And in a bull market, we do a 60-40 rule. Okay, everybody write this down, 60-40 rule. 60% of the time is a green day, 40% of the time it's a red day. So 3 days up and 2 days down. Essentially, on a bull run, you net 1 day a week long. So if Google moves $3 a day, in reality, it's moving a total of $3 a week in a bull run. So far, so good. Everyone type yes if you understand that. Candle count is a thing we teach so you understand in a bear market. Typically, every down day has an up day. If you count the green candles on the S&P, 1 day down, 1 day up. In a bull market, at best, it's 3 days up, 2 days down on any bull run you count. So we use that as a rule of thumb to gauging the timing of options. So if my Google's moving about $3 a day total, then I'm gonna move $9 up in 3 days, and then $6 down in 2. So once a week on that 3. So if Google, for instance, is at 88 and pumps up to 94 on a big single catalyst, I don't bet that continues to run like that. I go, okay, here's at 94, and every week I'm going to run up $3. Okay. So to get to 100 class, how many weeks through this method from 94 would it take Google to get to 100, moving $3 a day on 60-40 candle count? How many weeks total? If you guys can't count options like this, don't trade options. You need to think like this in weekly terms. How much do you expect your thing to move per week? Again, let me give you the numbers. Google, bull market. We are currently in a bull market because of bull structure, because we're above monthly hedge pressure on the S&P. If you're above monthly hedge pressure on the S&P, it's considered bull market where we do the 60-40 candle count. If you're below monthly hedge pressure on the S&P, you use 50-50, 1 day up, 1 day down. So in a bear market, you have to look differently. So in a bull market, you just look for that standard move per day, $3 per day. And if it's netting $3 per week because 3 days up, 2 days down, then to go from 94 to 100, to answer the question earlier, is I needed to go 6 points, which becomes at least 2 weeks. Okay. So let's talk about from this Friday to this Friday to this Friday in 2 weeks. Look at this. It took 2 weeks to get to 100, almost. It got to 99. You see how it's a pretty good way to estimate your timing. And we were so close. That's why I held on. But they were one. I'm sorry. We were so close. That's why I held on. And I still have until here. I'm touching my monitor with my hand. Let me do my mouse. Because these expire on Friday here. So essentially, let's assume that this Friday we're at 100. I'm going to assume I'm going to get to 104 by next Friday if it keeps going. If I lose monthly hedge pressure, I'm out permanently. We follow? So how far can I expect my options to go? To 104 by that Friday. How far can I expect them to fall? 97 by that Friday. So if I don't clear 104 at any time very soon, like today or tomorrow, then I have a risk of losing the entire position by next Friday. Do we understand? Because I can lose $3 per week or gain $3 per week. So I want to get at least $3 away out of the money to feel safe to just hold it to expire. And I'll ride it till the end. So if I don't get at least 103 by tomorrow, I will also be closing these Googles and rolling them out further. Because over the next week, I don't want to decay back down to 97. Or if I lose monthly hedge pressure today, I'm going to cut the whole thing for profit. Okay, that's not even doing monthly map. That's just doing basic, quick understanding. So let me go ahead and see what's actually possible, because that's an estimate trick. Now let's use Rocket Scooter to be a little more sophisticated. Hedge pressure is not shown on the screen. Hedge pressure is shown with Rocket Scooter right here. Monthly hedge pressure is way down at 90. So everything is still pretty solid. Okay, so let's do a monthly map. Now I'm going to show you guys how to do this. Everyone get your classic app out if you want to follow along how to do this, or do this in Rocket Scooter yourself. I like to do this in classic. I'm just so used to doing it this way. I'm going to type in Google. I'm going to put in single date, and I'm going to go through the monthly expirations one at a time. I'm going to draw it on Thinkorswim manually, because monthly map is one of the next features to come out. I'm going to draw it one at a time. So today on Google, I'm going to look for what Friday looks like, which is tomorrow. I'm just going to click tomorrow's date, single date, and click refresh. Okay. Let me take all of these old ones and delete them. So what this is looking for is just these Friday options and nothing else. So you can see very clearly that 96 is bullish, 94 is bearish. All you care about. And it doesn't surprise me that we can fall again close to 3 to 4 points. That's within the normal range and still stay bullish. Because remember, Google on average is moving at like $3 a day. So you can see that Google becomes bearish on a 94 break. These are the active positions. When you're looking at Rocket Scooter, these are the active positions right now. So this is the bear side of the market, and this is the bull side of the market. So we're bullish all the way down to 96. You still have bulls that have calls, right? And it's not bearish till 94. Let's bump out to the monthly and see what the 9th looks like. 96 and 80. So the monthly has that same effect, which is interesting. So on the monthly side, 96. And we're not bearish until 80. That's really low. Now, I'm sorry, I'm doing the 9th. Wrong Friday. And so in the Rocket Scooter platform, when it draws this, the way we're going to have this display for you is going to be very cool. Let me do the 16th, and let's get that visibility all the way out to monthly. I'm showing the days one at a time, 90 and 80. So you can see that Google is even bullish at 90 on the 16th. So how do you read monthly map, right? If you can look, I'll just draw it with Thinkorswim lines. Okay. You'll see that? There's all kind of information that's going to come from this. And let's just call that like bull side and bear side, right? I like to invert my colors. Don't judge me. Okay. A little text box for y'all to just watch this. Bull side. And after you learn this technique, you will never look at options again the same way. The most valuable technique you will ever learn, I promise, as far as swing trading and swing trading options. Okay, so Google can fall to 96 by this Friday and still be bullish. As of today, okay, let me preface this with these numbers change on a daily basis. So every day I rerun the map. So tomorrow I can run the map and that could be at 92, which means you can have a change. I'm just going to draw a dash to kind of imply the change. So like today's map could be where this dash line was. If tomorrow that moves to 92, then the map can change tomorrow. Do y'all see how every day the bull side and bear side lines will change. Okay, a little bit. The further out, the less they'll change, right? The nearer term expiration, the more violently they can change. Do we understand that so far? Everybody, yes? Monthly map is the most valuable thing that we can teach you as far as options trading goes and when to buy your expirations if you're swinging. This was designed for that. I use nothing but monthly map. Okay. Now, before I pick a strike price, let's get some information to start finding when I want my trade to take place, or if the trade to take place makes sense. So an example is, why did I pick 100s? Well, that's the half gap on earnings, which is right here, and we did support that today, which is great. Anytime you have an event, the half gap on the event, or the impact red line of the event, right? This is the half gap between one day and the next. Half gap is always one of the highest volume pivots on the planet. Did you know that? Half gap, as a matter of fact, is a higher volume pivot than hedge pressure. If you didn't know that, welcome to Rocket Scooter. Again, if you guys haven't subscribed to our service, there is nothing like what we teach. We will teach you predictive tools that don't use technical analysis. This half gap on earnings has been sitting there. Matt, why did you pick 100? Matt, how are you posting 20, 30K days? Matt, I want to get into trading, but I don't want to pay $100 for a membership. Money's kind of tight. Why the fuck are you getting into trading then? Right? Learn it. Buy a book. Learn something from people. No offense. But trading is a game designed to take all of your money from you. So you need to learn the game, or traders out there are going to feast on your remains when you're crying and out of money. Okay. Half gap on our Discord, if you look at our trading strats, is one of the highest volume pivots in the pivot equations. It's even higher volume than hedge pressure. Case in point, do we all see this? When you touch half gap or even get close to it, there's a volume spike. Do you see this volume spike right here? It is one of the highest volume hours of the entire 2-month span that's shown on my chart. Do we all see this where my mouse is? The only time the volume was even higher, even this massive day, I forgot if that was CPI or Fed, one of those days, I think this was FOMC, FOMC day, was still same hourly volume as half gap. Arbitrarily, half gap on some random moment in time, not only is resistance, but is one of the highest volumes there are. Isn't that crazy? So half gap is always a target I pick. So far, so good. Half gap supporting is also confirming a further gain on the target or the trade that I want. So Google was here. Google moves how much a day, everybody? Yeah, well, thank you for saying wow. All of our calculations predict volume. They all predict volume before it happens. Nobody can safely say predict anything with their garbage analysis systems that use technical indicators. We predict volume every single time. It is never wrong. You just can't predict which direction it goes, which is fair to claim. I will predict volume every single time and never be wrong. That's a beautiful thing to say when you're trading as a trader. All of our tools, all 15 of our indicators predict where volume will be at any given time. Half gap is between open and close from one day to the next. Now, again, all of our tools aren't programmed to Rocket Scooter. We're getting them all in as the weeks go by and new tools coming out every time. But half gap is the halfway point between the open and close of the session. So easily calculated as so. And there's a video we have called Predicting Price Targets that shows you that. So anytime you go, the first thing you ever do is you go to a daily chart, right? And start marking all of your gaps and half gaps. So on the way up, it's very easy to see all of your gaps, right? So let's just put it on a daily chart. Thinkorswim daily chart does not show after hours in the dailies. So that's great. This is the close of the equity session, the open of the equity session. So the gap fill would be for us to return to the close. The bottom of the red candle is the gap fill. The top of the green candle is the gap fill. Does everyone type yes if you understand what I'm doing so far? I'm just marking all of my gap fills. I'm just estimating them right on the edge of those candles. Easy to do this. So far, so good. Yes, yes. Okay. So in predicting and picking price targets, anytime the market is rallying, markets move up because market makers are trying to do what? What are they looking for? If you're raising price, then the market makers are assuming they're going to find what at a higher price? No, you never take the wick. The wick is something you do not. Great question. The wick is something that is arbitrarily the low of the day. It means absolutely nothing. The open and close of the day is what's important. If you look at what I'm showing you on the chart, every single trading day has you see this U-shaped kind of volume profile per day. The only massive imbalance that stock takes is the imbalance between the close and the opening, which is typically the highest volume of the day without a catalyst, no matter what the day looks like. So the open and close are the biggest amounts of trading volume, institutional positions, because the mark on open and close orders, those are the imbalances the market takes. Does that make sense? Market on open, market on open, market on close. So you basically say, market maker, fill me at the close. I don't care what it is. And everyone does that. They don't want to deal with the slippage and all the different things that come with day trading. They're just going to say, fill me at the open, fill me at the close. Yeah, so you're looking for sellers when you raise price. So if the market has a U-shaped profile, like today, for instance, market close, and there's a high volume here, and then the next day we gap up. So you raise price to look for sellers, right? So there is a buy imbalance at the close between this high volume and this open volume. So the open and close are high amounts of volume, and the fact that you gap up, it means the total of those two imbalances is a net buy, meaning that they're going to gap up to look for the sellers to match. They're always trying to balance, find sellers for buyers or buyers for sellers. If you gap up, the closing imbalance and the opening imbalance net was a buy imbalance. If you gap down, the net between the two was a sell imbalance. Remember, they print two different things. You'll hear the numbers at the end of the day. There was a 200,000 share sell imbalance at the close. There's a 300,000 share buy imbalance at the open. Well, there's a 100,000 net buy when you add the two together. But ideally, the open and closing price are big buffers of buyers and sellers. So anytime you have earnings that gap you down, it is a sell imbalance on the next day between day A and day B. So this volume and this volume is a sell imbalance because you gap down. You gap down when there's a sell imbalance. You gap up when there's a buy imbalance. Between the 2 days, though. Okay, so it's the net sell imbalance or buy imbalance at the close plus the net sell imbalance or buy imbalance at the open. It's both of them together. The net of the two nets is the direction you gap. Boom, right? Okay, so if you have a gap down, you are getting selling on that earnings report and then a sell imbalance as well. If markets are raising price, they're looking to find, this is where the sellers were. When you raise price, it's because they're looking for sellers, like people just typed in chat. So if you're looking for sellers, where are the sellers? Well, there they were. That's where they sold. So that's the gap fill is important to isolating where the bulk of the sellers were. If you're trying to balance the market, there's just a pinpoint location where you know sellers were. So let's move there and find the sellers. We have buyers now. There were sellers there. Let's smash them against each other. It's called liquidity, right? So what is the half gap, right? Well, the halfway point is that balance point between the two places. So if there's a huge amount of sellers, when you lower price, which is the opposite, you're looking for buyers. So if the market makers lower price to there, it's because they assume that's where the buyers will be. If the sellers at high volume were there and we open the next day, you gap down to find buyers on a sell imbalance, then that's where the buyers were. Then the midpoint is where they've calculated liquidity to be between those buyers and sellers. Now, in an earnings day like this, the market's highly volatile. So clearly the range is big, but the middle is where that balance between sellers and buyers are. It's the market maker's balance point between that imbalance. So it's the highest hedged spot because when the market makers have found liquidity, you are the loser of the trade. An example is, I wish I had a drawing tool here. It's the same thing as mean reversion. If people were selling here, or example, if people were long there, right? And all of a sudden, market makers detected a bunch of selling, so they dropped the price, but all of these longs are now upside down. They were already long. Okay, so let's imagine people already in a trade were upside down here. And then all the people that now shorted at the bottom based on the bad news are also upside down here. So imagine all of these bulls are upside down below here, and all of these bears are upside down in the middle as well. If the half gap is the maximum point of all previous positions and new positions being squeezed upside down. You think about it like that. If I drew the walls, it'd be easier to say. Here's an example: call wall and put wall. Call wall is where bulls are, put wall is where bears are. At 85 in the middle, all of your bulls are upside down. If I'm long at 90, well, damn, I'm losing money, right? And if I'm short at 80, damn, I'm losing money. The halfway point between call and put walls is the maximum squeeze point of traders. We're all losing to the house. So the middle is an area where everyone's losing and the market's liquid and the market makers are basically balanced. So the midpoint between imbalances or bulls and bears, between bears and bulls, remember, you drop the price when there's bears to find buyers where there's bulls. It's the same kind of principle. The middle is just a very, very large spot where the market is liquid and everybody's losing their trades. So imagine if you were a bull here, in the middle, you're upside down. And you're a bear here, in the middle, you're upside down. Market makers love to put price at the maximum squeeze point of everybody, because you're more willing to participate if you're upside down in a trade and you want to exit than you are to add money to a position. If you're winning, you're normally going to ride it. So at the middle is everyone's squeeze point. All of the bulls from way back in the day are upside down here, and all the bears from back here are upside down here as well. And from the earnings report, all the bulls that bond to earnings are upside down, and all the bears after earnings are also upside down. The maximum amount of everyone being upside down happens at half gap. So the maximum amount of position shifting off of that earnings report happens at half gap, i.e. half gap is the maximum volume that you will see post earnings of people deciding to get out of their trade if they made the long trade before earnings or the short trade after. Think about it like that. So half gap is a massive buffer and a massive volume anytime you tap it. There's all kind of hedging mechanics I'm not going into as well, but do we all understand what I'm saying here? Proof is in the pudding. When you touch half gap, look at that volume. This volume on the close was even higher than the FOMC open volume. It's massive, right? Anybody have AMC puts? I don't, but let's take a look at AMC. So long story short, half gap is always a profit target. And predicting profit targets on our YouTube channel talks about this. Half gap and gap fills are my targets, but half gap is also a buffer. So remember, anytime you get through half gap, it's going to slow down and fight there for a while. So you have to kind of consider that you might lose a week once you pass through the half gap as an estimate as well, because you're going to hit it and it's going to be like a random event. So while I expect, if the market is very bullish, to fill the gap if half gap supports, which is great, and I get bull signs, I need to know that half gap at least is my target I want, because when you get to it, it's going to fight for a while, as you see here and here. Do you all believe me now? This is complete. Why did you pick 100, Matt? It's half gap. At half gap, you sold half, as Mo has said. Baby, you got it, right? And I just started considering rolling my Google out further, because what's going to happen is we hug half gap. I might get a lot of theta decay because it's now at the money where theta decay is the highest. So here's how I do my swing entry and exit. Okay, cool. First, go to rocketscooter.com, get our software, and you can do these maps yourself. So maps are going to talk about where my risk is. Half gap is one of my reward targets, and so is the gap fill. So I'm hoping to get to 104.5, and I know that Google is moving about $3 a week. on average. So I can get to 104 by next week. That's exactly what I'm hoping to get. If I get to 103, 104, because they expire on the 9th, I'm going to close out. And if I still want to swing Google, I'm going to long it out further. How much am I going to lose on this position over any course of time? So if you guys remember, if you rewind a little bit, I did this monthly map. We're showing the market is bullish, and there's two things that you can take away from this monthly map. As of today, these are the actual positions held by market makers. What we're actually giving you, our technology isolates market maker activity from all the options. So where we are bullish and we are bearish, the market makers have puts and calls against our side of the market. If I'm bull, then they shorted to me and bought a call to go with it, right? That's what we isolate. So if you look at this, what that says is there are bulls at 96 and there's bulls at 96, and on the monthly, there's bulls at 90. So anytime people are willing to buy at a lower price, it's becoming more bullish. Even more bullish. Because if you're willing, if right now at 94, people are like, on this Friday, I'm definitely bearish at 94. But as of Tuesday, again, it's not necessarily linearly, but as of here, people are now actually bullish at 94 as opposed to bearish. Do you understand this so far? So the sentiment right now is if we go to 94, it's bearish, but if 94 holds, at this point in time, it's now bullish again. So it's a time and price. When you're trading options, time and price are both important, right? So as I look, as of this Friday, a dip to 96 is bullish. As of the next Friday, 96 is bullish. And as of monthly, 90 is bullish. So if I have my expiration for this Friday, and today, pretend that this move didn't happen. And yesterday we were trading in the middle, and Jay Powell says something, and we're now below 94. Then I know 94 isn't bullish until 2 weeks out. So not only am I out of the money, but I'm certainly bearish. I might want to get out of my trade. So any catalyst, like we're trucking along, any catalyst that dips to the bull side, I'm still okay. Trucking along, any catalyst that dips to the bull side, I'm okay. Ooh, catalyst, lower lows, but I'm still okay. Any dip out of the bull side, I'm out. Now, every day, like I said, every morning you have to remap this, and Rocket Scooter will ultimately, in probably the next couple of weeks, do this automated. But say if I wake up tomorrow and the wall moves from here to here. So the monthly map would therefore change from there to there. If this moves lower, then people are even more bullish on a shorter term basis. So the sooner people lower their prices, the more the bull market is. If it takes a further drop to be bearish, then people are also becoming less bearish. And if this slope is even bigger than that slope, then people are becoming less bearish faster than they're becoming more bullish. There's a word for that type of move. Let me write this down. People becoming less, this is a hint, I'm capitalized, bearish, then they are becoming more bullish. There's a word for that, 2 words for that, that you can decipher just from the 2 slopes of these lines. Short swoosh. Which side? Oh, less bearish, more, less bearish. I missed the most important word of that sentence. Faster. Makes sense. You're less bearish, more than. Let's analyze this English, right? More than they are becoming more bullish. I can't type today. Okay. Anybody here a doctor? I have a medical question, and I won't take this as medical advice. I'm just curious if this is a normal thing. So more bullish means you were buying. If people are becoming more bullish, they're buying at a certain rate. If people are becoming more bearish, they're shorting at a certain rate. If you're becoming less bullish, you are selling your bull position. If you're becoming less bearish, you are selling or exiting your bear position. So let's rephrase that. People are exiting shorts more than they are entering longs. I rephrased that using trading terms. There's a word for that type of trade that explains the upward momentum we're getting. It's not necessarily a bull run as people are entering and becoming, there are people becoming more bullish as you see the drop from 96 to 90 indicates that people are more comfortably bullish, but this faster drop on the bear side means it takes a lot more of a move for people to trust it's selling off. So this is a short squeeze when the bear slope is faster down than the bull slope is down. Short squeeze. That's how you see that on a monthly map. So the mechanics here are short squeezes, which are great. In bear market rallies, a short squeeze is that best premium jump you get. You love those short squeezes. People exiting trades always is a break of mean reversion. We always talk about that when we do the mean reversion classes in between the bull and bear side. I say the market's balanced, random in the middle. When you break out of the middle, don't I always say it's exiting trades that typically pushes it one way or the other? Do we understand? This is proof of that explanation. People are exiting, or people are less bearish faster than they're becoming more bullish. So while there are genuine buyers, there's really more people saying, get the fuck out of this bear market faster than they're like, let me get into the bull market. And that short squeeze is exiting a short, which is the mechanic to break the mean reversion. You see how it all comes full circle the more and more you learn? Yeah, watch this one tonight. So those slopes are a very good indication. Now, again, every day you're going to redo it, but if we had an indicator to the side of the chart, right now I would say short squeezes are in favor, right, than long entries or something. One of the things to note. So the mechanic of the movement is people are getting out of shorts. So people are exiting their trades, right? People are exiting shorts. They're not necessarily buying to find a bulk of sellers. People are just exiting shorts. Anytime you exit a trade, you're getting squeezed. Market maker is going to maximally punish you. But they're not going to reward the bulls either of a short squeeze. These bulls are not going to get rewarded, so the short squeeze is going to go right to the middle. So that the bulls are still losing and the bears are still losing. And short squeezes love to find half gaps. So if the mechanics of the move are short squeeze love to, if you want to write this down, short squeezes or long squeezes, people exiting trades love to find middles of ranges. Either mean reversion middles is the other way around. You will find exiting trades tend to break through those mean reversions. A short squeeze on a run up loves to find that half gap, because to go and break through the gap and go higher, it needs to be more bullish than it was back here. And more bullish let me delete this. If this was like that, right? And that was like that, then people are becoming more bullish faster than becoming less bearish. This slope is steeper, right? Just an example. Then the market's very bullish as opposed to short squeeziness, and therefore I will look to be the gap filling higher. So the slope of these two lines indicate my targets, and I'm going to write this down. Okay. Slope. I'm just going to get this for you guys. Bull slope less steep than bear slope. Then you have people are less bearish more than they are more bullish, i.e. people are exiting shorts more than they, or letting, when it's exiting shorts, or letting their shorts expire, right? More than they are entering longs, meaning short squeeze is the mechanic of the move. And that's how monthly map will give you that answer. The rock skewer indicator can just literally say, this is a short squeeze more than its long entry. And if this slope is steeper than that slope, it'll say a long entry. The market's now genuinely bullish more than its people squeezing shorts. Okay. Do we all understand so far how cool you get? How cool is this? You like this? Okay. How fast you can or can't get to your destination is candle count, Ite. So I said earlier, Google moves about $3. If you're above monthly hedge pressure, again, let me just make another thing. Okay. Above MHP equals bull structure, okay? Below equals bear structure. Okay, so far? This rule of thumb is done. Rule of thumb. Three days up, 2 days down. Net 1, 3 days down. Count the average move per day. Just eyeball it. Or like eyeball a non-catalyst. Google about $3 a day in the near term. So 3 days up and 2 days down equals 1 day a week. So $3 a day, and then so net per week is equal to $3 per week. So if I need Google to move $9, I need it to move 3 weeks to get to $9 on average. So if I am looking for a strike that is $9 out or later, I need at least 3 weeks to get there, assuming there's your average run. Okay, that's it. That's how I count how long it takes. Now, the next part of monthly map is figuring out what the map looks like once I figure out how long it takes. Okay, so we're in bull structure, and in bear structure, again, I only trade for, I get one, I don't swing trade shorts. Well, people say, what do you do on the bear side? I don't swing trade shorts ever. Never, ever, and never, ever should you either. That's the stupidest thing in the world to do. You're not Bill Ackman. Don't do it. You're not putting in millions and millions of dollars in a short trade and betting something to zero. The only reason you should short markets for a long period of time is if you believe a stock is worthless and it's going to zero. Does everyone understand? Don't swing trade shorts. Because in a bear market, candle count is 50-50. You can count any daily candles in a bear market. It's one down day for every up day, i.e., over infinite time, bear markets go nowhere. Over infinite time, over infinite time, the index always goes up, right? Over infinite time, many, many, many stocks go to zero and never recover as companies go under. But again, you should only short a company if you believe the company is worthless. Swing trading a short means swing trading means long term. Swing trading means I believe in the long term something's going down. And in the long term, the index always goes up. Why would anyone ever short swing the index? If you were short with puts, the minute you get that drop in one single day, you take your profits and run all of your profit. Don't even cut. I'm going to hold for longer. Swing, like if I'm like buying puts and I buy puts and I buy puts, right? And I get that day, I'm out of that trade forever. This is not what you want to do as a trader, because every other day is a green day. And imagine you're out of the money puts just losing money as the IV decays, right? You're gonna decay faster on out of the money puts because of volatility crunch than you will decay on out of the money calls that are less volatile for the most part. It's because of the way markets trade. Advanced lessons for you guys. Now, again, it's going to be the way market trades. You might not be able to easily see this by looking at the ladder, but let me give you an example. Actually, just trust me on it. When markets sell off, volatility and it's typically people exiting longs, and volatility goes up really high. You don't want to swing trade shorts. Do we got it? All on the same page? Shorting is a day trading thing only on the index itself. If you want to swing trade something short, it's because you believe it's worthless. The index in the history of hundreds of years has never been proven to be worthless. It's always gone up over time. So why would you try to take a longer term bet that the index goes down? Bear markets are very short lived. They can be years at a time and then they're over, and then you're bullish for decades sometimes. So in the longer term sense, the stats are in your favor to day trade short side and to day trade and swing trade long time. So swing trading is a long only effect. Why do I trade like this? Because your 401k managers trade like this as well. This is money manager's trick. No, it's not the same in bear structure. Bear structure, it's one day down and one day up. Great question, Bright. You do the candle count. We have a candle count video we did, but the philosophy is you can do a candle count. In any bull run, it's mysterious. I mean, any bear run, it's mysteriously 50-50. We actually counted all of this, and I did this on stream back in the day. But if you actually count from the high to the low, it was one green day for every red day. So the net over infinite time is bear markets don't go down. If it's one day down and one day up, one day down, one day up, then bear markets just don't go down over time. And clearly they don't go down over time. Eventually they always recover. For that phenomenon and why is it like that? Because everybody's always buying. Money managers are always buying when markets are dipping, right? They're always adding to the position. The cost basis average, because they do the same thing. Markets always inflate over time. The index does. So they're always willing to buy lower. There's always buyers in a bear market. They never stop buying. They usually sell at the top and then start buying the minute it starts crashing out, right? Does that make sense? So because if you count them, so traditional like really bullish runs are 3 days up and 2 days down, or sometimes one day up and one day down as well. But it's in between 60-40 and 50-50. The reason we quantize it to 60-40 is because there's 5 trading days a week and we do a weekly determination. So you can't have 2.5 days down and 2.5 days up. You have to discretely decide how many days up and down. So at best, you assume, at best, conservatively, you're going to get 3 days up and 2 days down in a bull market. In a bear market, it's pretty random in the short scale, but it's pretty predictable in the long scale. Randomly in a bear market, you can have 7 days down in a small burst of time, but over time, like in a crash, for instance, or a catalyst, for instance, you can have like 5 or 6 days down, but over time, you get enough buyers step in to where over time it averages to 50-50. Because it averages to 50-50, you don't swing trade for the hopes of having that 1 6-day run out of a year's worth of time. It's just stupid trading. Do we all understand that so far? How many times did Google quote unquote crash where you can have made $1 million buying puts and just held? Well, maybe from here to here, there's one period. This one drop here decayed for half a month before it continued to fall. Nope, that's not going to work. So when you're short trading or swing trading, when you're short trading, you literally want to get that one day and close it all out. Because you don't want to bet that it falls and keeps falling. There's always like months of theta decay before you hit your target. So even here, there's a nice run where you can become a millionaire just shorting right at that moment in time. Maybe any other days you had like 5 or 6. Maybe this run right here was just down, 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 maybe here. And then maybe you bet on earnings. So maybe 2 weeks, 2 weeks, and 1 week out of a 52-week period, there were 3 weeks where your short trade would have just made money day after day after day after day without theta burn. 3 out of 52, 6% chance that you're going to make money swinging short without a period of hesitation or a period of theta decay where you're just chopping around. Do you see that? And even this, I would argue, would decay theta because it's not a straight sell-off. So getting, like, when you're swinging short, you're saying, I'm betting the market's going to do this and crash out. But in bull markets, this has less volatility, so less IV crunch than that does this. So a sell-off, like if I swing puts and sell off and it retraces half, I have the same out of the money distance as I do on a long side. This will lose more premium per day than this retracing will lose being out of the money because of how IV works and pricing the trade, how volatility stacks up typically when markets sell off. So short trading retracement or sticky time when the market is not going anywhere works against you faster on the put side out of the money than it does on the call side even so. So when you're swinging shorts, you need the market to collapse and just fall. And again, I show that doesn't happen that often, right? So if you're swinging a short or shorting, you're not betting on the market collapsing day over day over day. You're betting on the market falling at some point. And when it falls that one day and just collapses, the end of the day is that maximum premium. That IV gets the highest it's going to be. That's when you sell all of it and you made your money. You don't bet on a company continually crashing unless you believe the company's worthless. And if you thought Google was worthless, you're not betting that it goes to zero right now. You're just building a short for the longer term, and you're planning for years out on a swing. So like, I'm going to swing it short for the month is just to me the stupidest thing the newer traders get trapped into, because they see that one day so-and-so bought puts and made $1 million. Ooh, that's going to be me. Well, maybe 6% out of the year, you might make that trade. And the other 94% of the time, you're going to chop out on theta burn, right? So because bear markets are unpredictable, and half the time, half the candles are green, swinging short on a medium-term basis is just suicide for your trades. So you should never swing trade short for a month or two out, betting that it continues to fall for a month or two. You might want to buy puts for a month or two out, but the day that you get that big sell-off is when you take your profit. And then if you want to still short that thing, you again reframe where you short it. Now, the difference with me is that as the market is getting my big run on the bull side, I'm not closing everything out. I'm adjusting my position, selling some for profit, letting it pull back a little bit, letting some theta decay, and then getting in a longer term thing. And that's exactly how I'm managing my longs. So a difference is in a short trade, I'll close everything out. If I still want to short that thing, I'll let it pop or retrace, and then I'll get another short for a couple months out. And then again, the day I get that one sell off, I close everything out and then wait a little bit, like I'm talking weeks to get back in. On a long trade, it's the opposite. It's a little different, I'd say. A long, once I get that big run up like yesterday, I'll start closing half or some of it out and adjusting the time frame to give me some longer time. I'm less likely to close everything because, again, markets, either they're bullish or bearish, have at least 50-50 candles that are green. And bull markets can go up to 3 days up, 2 days down, 60-40. So the odds are in my favor that bull markets are going to creep higher and creep higher and creep higher. The odds are not in my favor that bear markets are going to creep lower, creep lower, creep lower. Got it? So if you swing trade a short, the day you get your trade, take the profit, all of it. If you swing trade a long, the day that you get your trade like yesterday, take some of it or most of it, and then take the profit you made, let the market pull back, push the date out, keep going, like I did today. Now I push these Googles out. Push these QQQs fully out to the 23rd. And I'm debating on whether I'm going to push the Qs out or not and take some profit on it. You don't want to wait too many days after this big run up. I don't want to wait very long here. And of course, if we lose half gap, I might want to close. I don't like the way that it looks right now. And I am in the money at 101. So now let's talk about monthly map. And this is like a little side note. But let's talk about where I'm comfortably bullish. Now, an example is a monthly map is just telling me that Google can fall here or here or here on each one of these time frames and still be bullish. So if I were to draw, I guess I'll just use Thinkorswim's drawing tools, that Google could like do this. I'm just going to pretend like I'm going to map out like a pretend path for Google, right? Google can sell like this, like that, like this, and pretend that these are the same every day. So every day I'm going to redo this map. And say that Google is doing this, and then Google falls here and does that, and falls there. Is this bearish or bullish for Google? Everyone type the answer real quick. I'm going to the bathroom. Would you buy that dip at 92 on that day? Yeah, like, so the idea is that if, even though it looks like this, I tell myself if I want to get to my target, Google can fall all the way to here by that time and still be somewhat bullish. So I now know I can cost basis average at 192 if I'm swinging this long in general, right? So I know I can try to get my cost base as low as 92 and still be okay for the longer haul. And so monthly maps are telling me where my risk is, like where my stop is every week. Like I'm assuming that I'm out of the trade at 96 on that day, 96 on that day, and 90 on that day. So if Google's like just kind of goofing around right here, and then I'm saying, ooh, I want a long for the longer haul, and it starts drifting lower here, and the monthly map is still the same, I'm still cost basis averaging in down to 90, but only this week. If it falls to 90 here or 92 here, I'm not doing that. I'd close out all the trade if we lose 96 by Friday, right? So you're not looking at just price. This is an advanced, options are an advanced trading instrument. This is an advanced method. It's price and time. If Google falls to 90, like normally, if you weren't looking at monthly map out, if Google falls to 96 today, you might be very scared if it just drops right to there. I would buy the dip because I'm now looking at 96 not being price is a problem. 96 is certainly not a problem for the next 3 weeks. It's certainly a great dip to get in on. So when you trade options, time is more important than price. What does 96 mean? Well, 96 is bullish in all these time frames. If I come out tomorrow to trade, come downstairs to trade, and Google fell to 96. Let's put an example. Say today that Google just crashes to there, okay? And I bought the dip. And then I redid the map tomorrow morning. And now people have to be bullish at a higher price, which means people are becoming less bullish as time goes by. Say Google dips to here today and closes today and closes Friday right here, okay? Would you You bought that dip and it held on Monday, or you bought, say it fell there today to 96. You bought, it didn't go anywhere tomorrow. And at the end of the day tomorrow, you had a choice to make. Do I close? I bought the dip. Do I close it out or do I hold over the weekend? What would you do? So say you bought 10 Googles, right? 10 shares of Google. And then it dipped and you bought 100 more. You're like, I'm going to get that bull dip. And then Friday, the map looked like that. I'd close because nowhere after tomorrow does 96 prove to be bullish. Now, if Monday morning, I open the day back up, do my monthly map Monday morning, and Monday morning, it changes again back to there, then I will again start a new trade off of that new map. And if it looked like this, say that Google fell and was like this for like a week, and I said, okay, well, Monday rolls around, let me get back in on the long. I know that my long could dip to there and still be bullish over the long haul, but I need it to get above whatever this is, 98 by the end of that week. So if an example here is if that first trade I decide, okay, I'm going to close out whatever. And then I wake up Monday morning and we have a new map and it looks like this. So that's gone and all you have is this. And Monday morning looks good and I can say, ooh, okay, it's 96 and it could fall to 94 and it's still okay. So maybe I'll buy it 96 and it dips here and then I bought it 94. I'm long, my cost based average is here. And then Friday rolls around and then price is like so. I bought some more, trade went to there. It's Friday, and this is the map. You made a little bit of profit. Are you holding for the next Friday, or are you closing everything out for profit in this scenario? And I'm repeating, I bought here. The next day I bought there. My cost base is somewhere in there. And I got a little bit of a rally and made some money. And then Friday we close, it's 96 and some change. And then no, for the next week, 96 is not bullish. Would you close or open? Or close or keep going? Close. I would. Now you guys are starting to get it, right? So when are you swinging or not swinging? I'm letting the market tell me if I'm going to swing or close. So that was an escape to get out of the trade because it was, oh, then I messed up my map. What was the real map at? Let me just put the real one on there, 90 and 80. Because it won't let me go here, 90. And let's do the previous. So I was moving it around from the example, 96 and 80. Okay. You guys are getting it? Okay. So right now, what I have an example of is that Google is bullish and it's bullish even a lower target over the month. People are certainly willing to buy at a lower target. Now I have to tell myself, shit, for the next 1-2 weeks, Google could fall all the way to 90. And if I long at 101, I can go all the way down 10% and still be bullish. Am I willing to lose that much of my account? And do I have money left over to cost me to average in? So because of this, a monthly map will also prevent me from going in too heavy, too deep. If I want to bet on Google continuing the rally, I need to have a significant amount of capital just in case I need to hedge when markets fall. So an example, I'm buying Google calls for whatever reason, and I have some money left over to hedge. If Google falls to 95 and dips below 95, then I know I'm going to be not bullish at least for 2 weeks. So I'm going to need puts to hold me over for those 2 weeks. So right now, if I put $10,000 into 105 calls to continue the rally, and I put just $2,000 or something small into puts on the other side of the bull side, I can spend $2,000 to insure me just in case the market crashes so that I can make, double or whatever my money on that 5-point run, right? Delta 40 options or Delta 50 options from about Delta 30. If the market moves 5%, I'm going to make 40% of that 5%, which is, market moves 5%. So I'll make 2%. I'm doing this wrong. I can't do math right now in my head, but idea is like you can use a little bit of money to buy deeper out of the money puts to make against the money you make on the call side. Like I said, if I put in like 10 grand at 105s, I only need about maybe 96, 95. Maybe 2 or 3 grand in case it collapses, because while the distance is the same and the delta should be the same in both directions, the IV will stack up a lot quicker if the market collapses. And I could just spend a little bit of money on insurance to buffer any loss of the bull side. Instead of just thinking of like buying calls to day trade, you can also buy puts or also sell calls against your other calls and initiate a credit spread in the same fashion to collect a premium. So the smarter way to swing trade is credit spreads for the most part, or diagonal spreads. Monthly map, we'll teach courses on how to do credit spreads and diagonal spreads via monthly map. This diagonal spread incorporates different strikes and different times. You can have all different kinds of options to basically hedge. It's not just let me buy calls to speculate. Right now, if I want to fill the gap at 104.5 and I buy calls, okay, good. But what if I also sold calls beyond the next gap fill? Oh, okay. So how about today, I buy 104.5 calls for this Friday. Okay, it's dipping. Okay, man, I'm not making any money on this, but let me do a credit spread. Let me sell these and these, because 117.5 and 112.5, I think, are yeah. So like, say I sell right here and sell right here. So I have to like break through 3 very bearish resistances, right? So if I wanted to buy 105s, I could just sell a bunch of those and a bunch of these and a bunch of these for that week to just have a credit spread in case the market's falling off. So if we start losing half gap, I might start selling some calls to collect some premium while I'm waiting for my other calls to dip and rally. So now I have a credit spread, like I bought calls and I sold calls to pay for it. If you start to rally and get your trade right here, these out of the money calls probably won't lose that much because the delta is so small and the delta change is so small, but your near the money calls you bought would make a ton of money because delta's half, right, at this point. So if you get your trade, then close out the ones you were selling, right? So where you can do another thing is that when the market does rally to here, puts are going to be very expensive and calls are going to be expensive relative to the IV. So as soon as the market stabilizes for a couple of days, then if I really wanted to kind of get smart on this, I could buy puts and sell puts either way and initiate a credit spread on the other side. If I wanted to hedge my real long trade, say I bought Google shares, an example, just to rally, and I wanted puts in case the market was going to go against me. Well, my puts need to be protecting me on the bear side case or the non-bull side case in that example. So if I'm bullish, you can think of it like this. This is the bull side. And there's another way to think of it. Don't just think bull side and bear side. There's bull side, and then there's the not bull side, okay? And when you do not bull, it means that you need to hedge if you're in a bull position. So there's a not bull side, and there's a not bear side as well. So an example in this one, let me rephrase what I was trying to say. Let's say I bought Google shares, right? To swing trade the shares by themselves. Means I am bull. So if market is not bull side, then I need to be protecting my bull position because it's not on my side. So not bull side means I need to buy puts if it goes outside the bull side that I need. So an example is if I want to buy the best case scenario puts, the not bull side is the lowest at 90. So what strike would I want to get the maximum hedging is for my buck, right? The cheapest puts If I'm looking for a target for the monthly side, then I'm going to find the lowest bull side boundary to buy my puts at the strike, 90. So say that I'm longing Google and I'm going to hold it for at least a month and I need puts against it. Well, right now, those 90s are extremely cheap. And even if the market collapses one day, I've got puts hedging my longs. Now, pop quiz. I bought Google shares, for example. Market's trucking along. All of a sudden, Google collapses one day. And I had some 90 puts. Maybe they don't even go in the money. Maybe it goes to 95. But boy, those puts are up 600%. And I've got long Google that lost, I don't know, 5%. Puts that gained 600%. What am I doing with those puts? Google's fallen to where my mouse is in a single day. I've got 90 puts that are out of the money, but they made a big fortune just on the drop, and they're hedging my long. I've got puts to protect me in case it crashes further. I'm going to close. Why would I close? Why? Again, yeah, I hedged with puts. Why would I immediately close at the end of that day? Because you don't swing trade shorts, even when you hedge. There you go. You nailed it, right? So collect that IV. You lost 5% on your Google shares. You made 600% on your puts. Close those bad boys out and pocket that and wake up the next day and re-hedge again if you need to, right? Just hedge your long. Just re-hedge it again the next day. Your long shares didn't lose shit. They lost 5%, right? And you're out of the money. 90 puts made a whole lot, right? Just re-hedge your long with puts the next day. Redo the thing. Spend a little bit of money. Reformulate the map. Let that IV drop. Try it all over again, right? Don't even jump in the next day to re-hedge. You made 600. You lost 5%. Wait a couple of weeks. Like really let that map change out. Right? So the idea is that you can use this swing trading strategy to even hedge properly in that kind of certain way. I hope you guys like the lesson, right? Monthly maps are insanely valuable for planning. You just have to know. Now, an example, if I wanted to buy puts to speculate, then the best case scenario to break through bull side and go to bear side, I have to be below 80 at all times so that it's bearish at all times, right? Which means I have to lose bull side, lose bear side. And so on the bull territory, it's really silly for me to try to buy puts to bet that it goes bearish. So say that I want to buy puts speculatively over the course of the month. I need the most conservative puts I can get. Ones that I think, while we're falling in the bull side, will likely hit a bull boundary and bounce. The best I can hope for, that is, if I'm, again, buying puts and I'm bearish on the bull side of the market, then it's going to either fall to 96 this week and still be bullish, 96 next week, or 90 the week after. So the best case scenario I can hope for is this week fall to 96, next week fall to 96, and next week I fall to 90. If my puts are if I'm not swing trading, if I'm not picking a time way out here, and say I just want to buy puts just in case I have calls. Okay, now a shorter term thing. I've got calls for, I'm going to make up a number 110, and I want to buy some puts just to get the maximum bang for my buck, but not betting that we go bearish, just betting that we hit the edge of the bull side and go. So if I wanted to buy the best kind of puts I can to protect a bull call trade, now we're not just longing the shares and buying puts. Now we're longing calls and we're buying puts against it. That can be a very scary trade if the market goes nowhere and they're both out of the money. You can lose twice, right? Buying puts against buying calls doesn't necessarily make you anything. So you don't want to buy puts to bet that the market goes bearish. You just want to buy puts to bet that your bull trade you have, the long calls you had, are no longer bullish. So we don't bet that you jump from bull side to bear side without a catalyst. So say that I bought 110 calls for that Friday, and I just want to buy some puts that are going to gain a lot of momentum just to hedge those calls. Okay. Now, again, both of those trades are going to lose theta very rapidly. It's not a smart trade to do unless you're selling options against it. So you're going to leg into two sides, a credit spread on the upside, on the call side, and a credit spread on the downside. There's a certain kind of trade that's called. If anybody knows the answer to that, I really am impressed. Do you know the answer? You're talking about condors and butterflies at this point. A butterfly is two vertical spreads together. A little bit safer of a trade that will protect you from the market goes nowhere situation. If the market goes nowhere, then you're going to collect premium on the sold side. If you just buy calls and just buy puts, you're kind of stuck if neither of them go in the money, and you're kind of screwed, right? So the butterfly will give you premium against that market goes nowhere case, or iron con. Yeah, like you're in that ballpark. You guys nailed it. Okay. So ideally, say that I bought calls at 110 and I wanted to buy puts just in case it goes against you. Forget about the sell side of the butterfly, right? Just the long side. So my puts, I'm going to get the maximum bang for my buck to bet that the market falls. If I want the same strike, the same expiration, then I'm going to look at 90. So the market could fall to 90 by this day and still be bullish. So my puts are going to be 90, or even if I want to play both of them, I can do 96 and 90s. So I've got calls at 110 and I've got puts at 96 and 90. Where am I going to sell my puts? To bet that we don't go to the bear side. So I will sell 80s on this day. I will buy, so today, say today I bought I put 110 calls, I'm speculatively long. And I want to protect my long trade by selling and let's not even go to a butterfly. Just say that I don't even want to sell calls. Say that I just want to buy 110 as a speculative long, and I just want to hedge that by selling a vertical bear spread. So at this point, I can sell 80s for this expiration to bet that we don't go bearish, and I can buy 90s to bet that we go not bullish. And that's how monthly maps are fucking awesome. Because I have my time and I can put up a condor, I can put up a butterfly, I can put up a spread. So today, if I wanted to long Google to 105 to get that gap fill and I want to hedge it, I'll buy some really cheap out of the money 90 puts that will likely expire worthless. And I put I put 10 grand on the long, I put 2 grand on the 90s. And then I'll sell 2 grand worth of the 80s. Because if you fall from here to 90, those puts go right in the money and I just dump them all. But those 80s are likely to expire worthless. I can make money on both sides if the market doesn't go bearish. The market stays on the bull side, I'll hold on to the ones I sold all day long. If the market falls rapidly and hits my strike, I'll close out that leg of the trade, right? So monthly map allows me to strategically leg in and leg out of options trades in any kind of setup, a butterfly, condor, buyer, sell side, vertical spreads, you name it, right? So the neat thing is right now, I know where I want to long to the next strike, again, repeating. Where I want to hedge against is puts for that strike. And where I want to sell my puts to pay for these puts is below here. I sell them dollar for dollar. If I put 2,000 in to long those puts, I want to sell at least $2,000 worth so that my net cash sweep is 0, right? The premium made somehow matches the premium loss, but out of the money if the market does move, those 90s are going to gain faster than those 80s are going to lose, right? Because the delta will be higher. So at no point will I get a margin call on that trade. I'm filling a vertical put spread. Now, it's hard to wrap your head around this as a trader, but options traders will understand that. If my buying power is 0 and I long 90 puts and I sold 80 puts and the market's collapsing, those 90s will gain more than those 80s are losing. So my net cash sweep will be positive. I'll be actually gaining buying power in that trade. Does that make sense? So the idea is you want to be in a situation where you're hedged properly. And you can use monthly map to do this in a million different ways. But anyways, that's the session for today. I'm glad you guys decided to tune in. And monthly map will be a bigger part of the next couple of releases of Rocket Security. You guys can tell all your friends that we have this tool that helps you plan options trades months out. And you can feel free to try out the free trial. RocketSecurity.com free trial. We love you guys. Thanks for tuning in. I'm going to get back to Discord, so we'll be there all day chatting, and I'll talk to you later. Okay, go to the Discord. I'll give you the link. And actually, before we go, let me just reanalyze. Yeah, no problem. I'll clip this and release this part of the video as a separate clip. All right, love you guys. We'll see y'all. Bye-bye.